He was a janitor. He had $120 in his bank account. 2 years later, he never had to punch a clock again. This is exactly how he did it, step by step. No get-rich-quick trick, no pump talk. A real plan that turned tiny savings into steady freedom using small risks, AI tools, and smart crypto moves. Watch the 4 steps and do and skip the chart at minute for 30. It explains why holding cash is quietly killing you. His name is Samuel. He worked nights, 2 jobs, no college. He believed what everyone told him. Save, play safe, retire. But his savings didn't protect him. Inflation did. One winter, his boss cut hours and the lights in his street went out for weeks. Samuel had $120. That night, he decided something had to change. So here's what Samuel did for moves: repeatable, low-tech plus high leverage. Move 1, reallocate, not hoard. Samuel allocated $50 a month differently. $20 into a low-cost index crypto split, $20 into upskilling, $10 in short-term opportunity cash. Not huge, consistent. That discipline builds optionality. And it all started when Samuel found this video about buy and masks, made a few simple tweaks, and bought Bitcoin and ETH every month. In December 2020, he found this channel and learned how to diversify risk and beat inflation through crypto. But we have to go back to move 2. He spent $150 on a short copywriting course, then used AI prompt templates plus automation to deliver 10x faster. He landed a single freelance gig that paid $700. AI didn't replace him, it multiplied his output. And everything changed when he discovered this free AI tool. Let me show you. Here's a marketer who needs a cold email campaign. They type their request into this box. Now click Generate. In 10 seconds, the AI will write a highly targeted marketing email. So Samuel could create 10 emails in 10 minutes, and that's how he got noticed. That brings us to the chart. This chart tells the whole story. Wages flat, prices up, assets up. If you keep cash, you slowly lose purchasing power. If you hold assets that outpace inflation, you win. Chart sources on screen. On to move 3. He micro-invested into asymmetric baits. Samuel used $100, $2 cost into a diversified small basket. 60% index, 30% crypto, 10% experimental tokenized assets or early-stage projects. It's not gambling when it's small, repeated, and tracked. Move 4, compound the work with automation and reinvest. After he scaled freelance gigs using AI, Samuel reinvested the extra $500 a month into the same mix. The compounding effect did the heavy lifting. 2 years later, he had multiple income streams and no longer needed the night shift. And finally, a word of caution. Look, not every small investor becomes rich overnight. But consistent allocation plus skill plus small asymmetric baits changes the odds massively. It took Samuel less than 2 years, but he didn't just find one video and then go passive. He applied, he learned, and he adjusted. Now, here's the thing. There are 2 main types of channels on YouTube, right? The kind that tell you how great crypto is, always pumping, moonbags, Lambos, but then you look at their portfolio and you see they're only talking about capital gains, not accounting for inflation. Or channels that try to scare you into investing in boring old index funds, or worse yet, just sitting in cash. The problem is this. Let's do some math. Since the Great Recession, the S&P has returned around 16% per year, which is fantastic. But if you take inflation into account, that return drops to 7%. And guess what? The average savings account interest rate today is 0.5%. 0.5%. That means if you're holding your money in a savings account, you're losing 6.5% each year. To put it another way, your $1,000 turns to $998.70. In other words, inflation is eroding your savings. Now let's look at Bitcoin since the Great Recession. It's returned almost 20,000% even after several halvings and drops. You might be thinking, hey, but crypto is so volatile. Yes, but remember, Samuel used dollar cost averaging. He consistently bought in every month. And remember, volatility is a double-edged sword. You buy low and sell high. It's like going to the grocery store when there's a sale. Everyone else is panicking and you pick up extra groceries because the price is low. Then, when the price goes back to normal, you can sell those groceries for a profit. Finally, let's talk about the markets. As you can see, the S&P has climbed steadily over the last decade. Let me be clear, I am not anti-index fund. I actually invest in them myself. But the question you have to ask yourself is, are you really getting a return above inflation? And the answer is probably no. Now, what about Samuel's portfolio, the one that grew to $30,000 in just 2 years? Well, that's because he took small risks, mastered a skill, used AI, and diversified across different asset classes. In fact, let me show you what Samuel's portfolio looks like today. Out of his $30,000, $12,000 is in a diversified index fund covering both stocks and bonds. $9,000 is in Ethereum and Bitcoin. $6,000 is in smaller coins with potential upside. And $3,000 is in investments with even higher risk and reward. Now, before you say that's too risky, let me remind you, Samuel is 28 years old. He has time on his side, plus he's earning over $10,000 a year from his freelance work. This means he's earning more than his investments are currently returning. And when he reinvests his earnings, he's buying at an even greater discount. But here's the best part, Samuel can earn money even if the markets go down. For example, if the market tanks and his investments lose 50%, Samuel would still have $10,000 from his day job. And guess what? He's making around $800 a month, which means he can keep buying in during the dip. Now let's imagine the unthinkable. What if he loses his job? Well, he has $2,000 in cash, enough to cover 3 months of living expenses. Plus, he's got his freelance skills and the knowledge he's gained from taking small risks. By the way, these ideas aren't just some get-rich-quick scheme. They're backed by numbers. For instance, let's look at the top 10 millionaire-building habits according to a study of 2,000 millionaires. What do you think the most common habit is? Saving. How many times do you think they mentioned saving in the video? 0. The idea that you need to save to become a millionaire is a myth. In fact, it's dangerous. Saving doesn't make you wealthy. Saving is a habit, not a strategy. Wealth comes from having a plan, mastering new skills, diversifying your income, and managing your finances well. For example, let us look at this graph showing the value of the median home versus the median household income in the U.S. from 1980 to 2020. What do you notice? The home's value has skyrocketed compared to income. People are working hard but not becoming wealthier. The system is designed for you to work hard and barely get by. When was the last time you heard a politician talk about creating an environment where people can thrive, where you're rewarded for your hard work? It's rare. Back to Samuel. His total investment is just $1,200 a month, around 4% of his $30,000 portfolio. But the key is that he's been consistent and disciplined. He's never missed a month. By following these steps, Samuel has built a safety net of 6 months' living expenses, a reliable income stream, and a portfolio with upside potential. He's diversified, he's automated, and he's constantly learning. The bottom line, even with small steps, you can build a secure financial future. If you want the exact spreadsheets, AI prompt pack, and the 3-step DCA template I used with Samuel, hit subscribe and comment send. I'll pin the download. Don't wait. The future is moving faster than you think.